This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker, and I'm here with Manus Clancy. Welcome to this week's episode. Well, Manus, today was the fourth of 8 Fed Wednesdays of the year. Rates held steady, which surprised nobody. Stocks wobbled as rate cut hopes faded, with the S&P giving back ground after trading near highs earlier this week. We saw oil prices pull back below $80 as optimism grew around a possible U.S Iran agreement, so that offered the market some relief. Bond yields fell earlier in the week, but popped after today's Fed decision. And then last, the SpaceX IPO rally is starting to cool. So lots of things to talk about, Manus. What are you watching?
Thank you, Dianne. It really has been a week with two parts. Part one started at 2 p.m. Eastern Time in New York with those Fed remarks. The markets had been treading water for most of the day. The NASDAQ, S&P 500 were basically flat until mid-afternoon New York time. Bond yields were kind of hovering around that 443 level, which is where they've been for a couple of days. And then the Fed came out, made their announcement, which was uneventful. But market analysts didn't like what they heard. The major U.S. stock indices sold off. The Dow fell 500 points. The NASDAQ was down 1.4%, and the S&P 500 down about 1%. Bond yields at the same time moved higher. The yield on the 10-year jumped from 443 to 449. So the welcome for new Fed Chair Warsh, you would not call it a warm one. I would say it was a wet blanket over the new Fed and the remarks. Is this a lasting trend? Is this something that people will be concerned about for a couple of weeks? Will it trigger a renewed sell-off tomorrow? Impossible to say. I think that this was a knee-jerk reaction, but we'll find out. The rest of the week, part one of the week, was defined by Iran and the deal that was announced on Sunday. We've had several of these announcements only to find out that Iranian leaders were in disagreement. They would race to their keyboards and respond by saying the president is not right, we don't have an agreement, and whatever enthusiasm had been generated from remarks by the president in past months was quickly erased. This was the first time we had a deal where the Iranians didn't race to the keyboards and say, not so fast. And the markets reacted very, very positively. We had a huge melt-up on Monday. Stocks surged. The NASDAQ was up more than 3% on Monday. Tech shares just raced higher. We saw oil prices drop dramatically, as you mentioned, now below $80 a barrel. And bond yields came down. We saw the yield on the 10-year drop from 455 to about 443. So we know these things are fragile, these agreements. We know they've fallen apart before. But this is the moment you and I had been waiting for, Dianne. We were waiting for that moment when peace would break out, not war breaking out. And if this holds, our thesis will be tested. That thesis being bond yields will head back to 4%, oil will head back to $70 a barrel, and market activity will surge, particularly in CRE. But it is fragile, and if this thing breaks apart in 4 days, I'm not sure anybody would be that surprised.
I know. It's almost like this year you have to be ready for anything. And, to your point, I was just thinking earlier today that a month or so ago, we would kind of talk about the conflict in Iran in the context of the mid-year mark, being a pivot. Like if the war extends past mid-year, then we've got problems. And I looked at the calendar and I'm thinking, okay, here we are, 13 days or so from mid-year, and maybe we're close to a resolution. But I think we've all been conditioned at this point that anything can change in a day. And certainly the hope is that the ceasefire holds, the Strait of Hormuz reopens, it brings down yields, as you said, over the back half of the year. And that would be a very meaningful tailwind for the sector. So, at this point, who knows? The new theme for the second half could be, is it slow and steady, or will the end of the conflict be more of a booster shot, in the arm for the market? But first, we have to see what happens if the agreement takes hold. I wanted to double back a little bit, Manus, before we go on, about what struck me about the Fed's decision today. I mean, the decision itself was unanimous and it didn't surprise anybody. But like you said, it's the dawn of the Warsh era, and the press conference that he gave was a much, much shorter policy statement than what we would get from Powell. And he dropped the forward guidance element entirely. And I used to love reading that. It was kind of a way to telegraph the Fed's next move. Why did he drop it? Maybe he wants maximum flexibility, like a king or a queen on a chessboard, to move in any direction without having to walk back on any of his prior statements. So I think with the Fed's guidance going away, it makes the view forward a little bit murkier. I will say that our CRE activity index for May was very positive, still in the triple digits, as we've talked about on the pod last week. I think investors are making long-term capital allocation decisions. They're focusing more on Treasury yields and longer-term borrowing costs more than any Fed move. But the chatter about the Fed hikes is out there again, and certainly nobody wants to go in that direction.
Well, if the peace deal holds, and if we see declining oil prices continue to decline, if we see what was a nice start this week gain momentum and like a $70 a barrel number become a real thing, I think we're going to see some really, really upbeat CPI and PPI numbers in the second half. And it begs the question, why would we have to raise rates right now, if not for the fact that perhaps the Fed wants to take away some of this enthusiasm we're seeing in the equity markets? If that's the case, if there are Fed presidents who are saying all these record high NASDAQ trades, the $1.8 trillion or now $3 trillion SpaceX valuation, if this is dot-com era all over again and they want to take away the punch bowl, they should say so. They should say that that's the reason. But they should be prepared for some very positive CPI and PPI prints in the second half. And I would say that if that's their only motivator, CPI and PPI, there's absolutely no reason for a rate hike. As far as the dot plot goes and where they think they're going to be in 6 months or 12 months, I was always perplexed by that. I always thought the commentary was terrific. It was great to know how the Fed was thinking. In my mind, if you're thinking, well, rates should be 100 basis points lower 9 months from now, why not say they should be 50 basis points lower today? If you're saying the data is pointing you in that direction, why not make the move now? It seemed kind of cautious for caution's sake. I never really understood that part of it, but we'll see. I think Warsh is going to be a man of few words. As you know, Dianne, I am a man of little words. It and was and the and be. But Warsh is a man of few words. And I think it'll be a little bit harder to know what everybody's thinking behind the curtain.
Yeah, I think so too. And it means smarter underwriting, paying attention to the longer term picture with more volatility. So it's like I said, it's the dawn of a new era. So we'll see where this heads.
Hope is not a strategy in CRE. And we've seen so many different people on LinkedIn and Twitter and other places point this out. And it may seem like pointing out the obvious, but unfortunately, too few operators go in with hope as a strategy. They go in with the notion that if I buy now, all I need is rates to drop 200 basis points and I'll make $10 million. But hoping for that 200 basis point drop is no way to predict the future, right? That was the hope that we saw in 2022. People were hoping that by the time they value added their property, that rates would still be 3% and they could flip out at the same cap rate as they went in, just with a more upscale property. They learned the hard way when rates went from 3% to 7% that strategy was flawed. So one has to be careful here that we hope that rates go down. And if they do go down, we think that it will supercharge the market. But you can't expect that and you can't time it for sure.
Right. The same as not being able to hope that prices will appreciate as a given over the course of ownership of an asset, which is why I think it was Ryan Severino who first called this the era of asset management, because for owners, not being able to be assured of what the rate picture might be down the road, whether prices will appreciate, makes it more important to operate the property intelligently, investing in improvements that will hopefully drive a stronger ROI down the road. But it's a very, very different market, just to state the obvious, than it was, even several years ago.
It will be very interesting to see if we see a meaningful decline in the 5-year and the 10-year, and we get back into something that's like a mid-threes, whether or not people have learned their lesson, or if we go back to the go-go days of 2021 and 2022, where people are just chasing valuations higher and higher and higher. Whether those singed fingertips remain kind of scarred or if people just kind of move on to the next bond rally.
Mm-hmm.
Before we end up this first segment, Dianne, and move on to our data dive and our market stories, I have to ask you this. You saw the SpaceX story. It was oscillating back and forth in terms of whether it was worth more in market cap than Microsoft or less in Microsoft. But either way, it's at that $3 trillion level that Microsoft is at right now, give or take. Any hot takes on this? Is this reflective of a market that is overheating, or is this the beginning of the new world that, just like the internet changed everything for us, AI, space exploration, data centers, this is going to take the U.S. economy to places we can't even imagine?
I don't know. It's such a head scratcher because it's by exponential degrees, it's different than any other sector than I've seen, certainly in my path of watching the stock market. But I mean, my take on SpaceX's market debut is it kind of became a big risk sentiment story. They had something like a 50% surge above its offering price. Shares started to pull back as this buying frenzy started to cool. I'm always a laggard, so I would never be one to kind of jump in. I'd be afraid of overpaying. But I think all in all, investors, they're looking for these big growth narratives, and that's what's driving a lot of these headlines. But I think what we talked about last week is true, that valuation scrutiny is really rising fast, and they're starting to kind of question the valuations and what the returns might be.
I don't usually make predictions on things outside of CRE or sports, but I'll make one here. And I will say we will look at this to some degree as a market top sometime in the next 2 or 3 weeks, and that buyers will have the opportunity to get SpaceX at 25% off where it is now at some point in 2026. That would be my prediction. I think SpaceX will be successful. I do think there is incredible opportunity for the satellite business to disrupt telecoms and cable companies and so many other things that I think the money will be there someday. But I do think that the euphoria and excitement is outpacing the potential at the moment, especially among retail investors.
Yeah. So you weren't part of that initial wave that jumped in?
No, but I might be a part of that wave that jumps in if we get that 25% discount. I'm a believer long term, but it's like buying Tickle Me Elmo right before Christmas, right? 15 years ago, that you knew you're going to be able to get a Tickle Me Elmo 6 months later for the cost of manufacturing, basically. But if you have to get one on the day before Christmas under duress and drive to Maryland in the process to find one.
That was a horrible toy.
All right, Dianne, it's that time of the week where we, drum roll please, throw it over to you for the weekly data dive.
Thanks, Manus. We're going with a geographic focus this week. So I looked into our scorekeeper model for environmental due diligence volume and the top 5 metros year to date through the end of May. I always like looking at these because environmental due diligence happens before commercial real estate loan originations, refis, new investments. So it gives a look into where investors are focused and how that interest is shifting geographically. So top 5 metros that have the highest growth this year for the first 5 months of the year versus last year are, in order, Long Island. So hello to our friends on Long Island, east of Manhattan, Austin, Nashville, LA, and New York City. So those 5, I saw a mix of big gateways with LA and NYC joined by Long Island, Austin, and Nashville. So there's a lot of activity to go around in these days of very, very highly differentiated markets.
It would be interesting to have our friends from EDR join us one of these days and kind of take us beyond the headlines here to figure out why some markets are doing well, even though they have very different profiles. When you look at a metro like Nashville, it has been on this hyper growth track for a long time. So it's really no surprise that we're seeing a lot of activity there. But you wonder what's happening on Long Island. Most of Long Island was built right after World War II. And you're thinking there isn't an acre of land to put up something new. So all of this must be transactional in nature, not new development. But the EDR guys will probably know better than we do. It's interesting. Same thing with LA, right? LA does not seem to be a vibrant market right now in terms of new development, other than perhaps in areas that were fire damaged and people are trying to get their arms around, right? Is this safe here, right? What has the damage been environmentally? So it would be interesting to know what creates momentum out of a place that seems stodgy or business unfriendly or already highly developed. We should make that part of our second half resolution.
I love that. Maybe we'll get some emails from folks on Long Island or LA looking to come in and give us their 2 cents. But I mean, Austin and Nashville, I've been to both of those cities recently. And like you said, with regard to Nashville, there's so many cranes and so much construction. And the same was the case with Austin. All around their convention center, there I probably counted a dozen cranes just within like a 3-block radius.
Nashville and office, they passed the sniff test. Long Island and LA, not so much. So let's move on to our second regular segment that we do every week, the Did You Know?
Yeah, so for last week's Did You Know, we took a turn to do kind of a day in the life of LightBox and put numbers around what's crossing the tracks in a typical day. So last week, we shared the average number of environmental due diligence orders. And this week, to use your visual of a time lapse of a major highway, Manus, we are focusing on the lane that fuels appraisals. So thanks to Nathan Dever for this one. On an average business day in 2025, there were 546 awarded jobs for appraisal RFPs in our lender platform.
So just to scratch beneath the surface there, for those that don't know our 2 franchises that do this, we have one called RIMS and one called Collateral 360. This is an efficiency device used by 1,200 banks in the United States to basically demystify the appraisal procurement process. People use those systems to come in to order an appraisal from pre-approved appraisers within certain markets. So a major New York bank in Charlotte may say these 17 different appraisers are approved for appraising industrial properties within 100 miles of Charlotte. They throw out a job procurement bid. Anybody who's pre-approved can come back with a price and a time frame with which they can fulfill the job. And it's complete B2B. There is no Rolodex, there's no phone calling, there's no vetting people. It is the ultimate in efficiency. And over the last year, maybe you've heard us talk about this in the past, banks are now taking the output of this process, which is a 200-page appraisal every time, running it through tools on LightBox to instantaneously digitize all the findings in that appraisal and compare those findings, whether it be cap rate, discount rate, value per square foot, value per unit, et cetera, average expense, vacancy, to what they've seen for other like appraisals across their entire book of business. So somebody could say, look at this. We're appraising or having appraised for us a 800,000 square foot industrial property. This appraiser is using a cap rate of 525. That is 50 basis points lower than the last 6 appraisals we've seen of like properties. And that leads to better decision-making, better risk management, more risk mitigation. And it's been a great thing. I was grateful to be part of the team that actually helped build this. And it was so educational for me. And it was a terrific team, by the way. So I love the data. And think about that, 500 of these things being procured every business day through the LightBox Superhighway.
Yeah, excellent background. And that is a truly impressive process. I mean, those data points that you mentioned used to be kind of imprisoned in a PDF document, and now they're all available for new kinds of analysis that would have been not impossible, but extremely time-consuming to do without that. So kudos to everybody who worked on that.
I should announce the band here. This is like Bob Seger at the end of a show announcing the entire Silver Bullet Band. So without further ado, Nathan, Labat, Apoorv, Mimi, Chai, Ron, Julia, Zach, Matt, all the team that was correcting and improving data. I'm sure there's people I'm forgetting, but that is me shouting out the Silver Bullet Band that put together that whole data extraction process, a real crack team that did great work. And forgive me if I've left out the saxophonist. I probably did, but I will come back and fix that next week.
That's fabulous. I love that. All right, Manus, let's move to the deals that caught your eye this week. Where do you want to start?
How about we start with office leasing? We haven't talked about office leasing for a couple weeks. And the first one, this comes from Hannah Kanik of the San Francisco Business Times. In San Francisco, the biggest lease in 8 years was signed over the last couple of days. This is 500,000 square feet of space. It's a lease expansion by San Francisco city government. The lease is for 1455 Market Street. And if I'm not mistaken, 1455 Market was one of those CMBS properties, big CMBS loan, that was kind of left for dead. I'll have to go back and look for sure, but several major tenants pulling out, vacancy spiking, real decline in value. I believe that that's the case. I will go back and confirm if I was wrong. I will correct the record next week. But San Francisco hit hard over the last couple of years with vacancies, people pulling back, quality of life issues. Now the biggest lease in that city in 8 years. We love that. The second one, Huntington Bank in Chicago, doubling its space at 222 North LaSalle Street. That building will now go to 87% leased. Chicago, perhaps the worst of all major U.S. cities in terms of value decline and vacancy. People pulling out of those 400,000 square foot leases, slashing space, moving to the suburbs, reducing their footprint by 75%, values dropping enormously. Here we have Huntington Bank going against the grain, doubling their footprint in the Windy City. And I love happy stories, and those are two happy ones to start.
Yes, they were, Manus. I don't have the reporter on the Huntington Bank story, but that was published by The Real Deal in Chicago. You know what was interesting to me about those two examples is I had just read a story in the Wall Street Journal by Peter Grant where he was talking about New York City's office leasing and that Manhattan's office market is having its best leasing performance since 2000 and that it's driven in part by AI firms. And here you come with two stories that are about two different cities, two different tenants, one government, one bank. It's not AI. And it's evidence that not every tenant is shrinking their office footprint. Not every building is losing. And, government tenants, like maybe a headline about a government tenant signing a big office lease doesn't have the same sizzle as a headline about this AI giant signing a big lease, but they boost occupancy in a city like San Francisco that's been struggling with office leasing. And Huntington Bank is interesting because it's the financial users that have been among the tenant groups that are reassessing footprints. And here's one that, as you said, is nearly doubling its space in Chicago. So these are great stories, strong tenants making big commitments on office space.
You ain't seen nothing yet, Dianne. I have more happy stories than you could shake a stick at. So I have several from this week. I think I have one negative story, but 3 or 4 more positive ones. And without further ado, should we move on?
All right. Yeah, I love it. That was a nice teaser. Jump in.
Here, one is a really happy one. In South Florida, this story comes from Commercial Observer's Julia Etchison. Prologis spending $350 million on a 1.2 million square foot campus in South Florida, making it the top South Florida industrial sale of the year. This particular property is a fully leased 7-building warehouse developed by IDI Logistics. So there we are. Happy story number 3. Elsewhere in the Southwest, the story from Helena Wegner of the Phoenix Business Journal. In California, Aris Mesa LLC, I'm not sure who the ultimate owner there, bought a Mesa warehouse for $116 million. This is known as the Cubes at Mesa Gateway, Building C. Lowe's is the tenant there. This is a Class A warehouse at 7111 South Crisman Road, and it covers 268 acres and ultimately will have 4 million square feet of space once the entire set of buildings, those in addition to Building C, are completed. So 2 big industrial deals for this week, Dianne.
Yeah, it was interesting. I mean, To someone who lives in New England, talking about a 268-acre industrial park is not trivial. And I saw a stat that Cushman and Wakefield described that one as the largest single building industrial sale in Phoenix so far this year. So investors want a big box logistics exposure. They want durable income attached to it. So you can't go wrong with the lows, especially during DIY season.
The thing that impresses me the most right now, you and I were a little bit concerned a couple of weeks ago that even though our index was showing ongoing momentum, that we were seeing numbers that were the highest they had been since 2022, we did see a modest tail off at the real high end. The number of 9-figure transactions being reported, it seems like in the first half of June, we're back to where we were in April. That we're seeing a lot of big deals getting done. We've seen a $1.8 billion industrial portfolio sale. We saw a huge student housing sale. We just rattled off 2 9-figure industrial sales. We have more in the hopper before we go today. It just seems like we're back to interest rates not mattering, and people are going to go through whether the 10-year is at 375 or 455.
So are you saying that folks should take their summer vacations now in case the peace agreement goes through, oil prices come down, and the 10-year comes down too?
Well, I think the second half is going to be busy. If the last 3 months have told us anything, it's this market will not be put off by $100 oil or interest rates, which are 75 basis points higher than where they were 4 months ago. So even if all we do is continue the current trajectory, we will be busy. If rates fall to 390 on the 10-year, and if oil does get to $70 a barrel, I think it's to infinity and beyond. Right?
Nice.
Since we have Toy Story 5 coming out this week, I had to throw in the Buzz Lightyear reference, of course.
Wow. First Tickle Me Elmo, now Buzz Lightyear.
Yes. And I'm very loosey-goosey today, Diane, I have to say. I'm just... It's a complete stream of consciousness, I must confess.
There's nothing wrong with that.
I will take us to one more record-breaking story. We've already talked about big numbers in industrial, big numbers in office, or in the leasing side of things. So let's go to senior housing. This story from Angela Gonzalez of the Phoenix Business Journal. Stonepeak paid $109 million for Akoya Shea in Scottsdale. This is a record-setting per unit price. The property is a 147-unit senior living facility. It is the highest sales price, not just this year, but in Arizona history in that asset class. The number, if you don't want to get out your abacus, $740,000 per unit. This is sold by Harrison Street Asset Management and Coger Senior Living.
I read that the Phoenix Metro 75 and older population was expected to grow by nearly 23% by 2027 when this project first opened. So, those numbers that you threw out there are significant, and it shows that senior living is having its moment in the right markets if it's sitting at the intersection of demographics and necessity-based demand. But I have to tell you, Manus, that gave me a reference to a story that I saw this week. I'll digress just for a little bit, but my college alma mater is Goucher College, which is north of Baltimore. At the time, it was a tiny liberal arts women's only college. They were just in the Wall Street Journal because part of their new strategy to offset enrollment declines is they formed a partnership with a senior living facility next door, and residents in their 70s and 80s are now taking classes with underclassmen, using campus facilities, joining events, and I know you love a pop reference. It conjured up Rodney Dangerfield in Back to School, and I hate to even bring that movie up.
I always love Rodney, and that movie always made me laugh quite a bit. The triple Indy at the end, one of those iconic movie endings. I have to think if I would like that or not when I was in college.
I know.
I'm thinking about it. I'm trying to be very objective about this. When I went to college myself, there was no real grade inflation. That there were A's and B's and C's and D's, and every class had, some representation in each. It wasn't like Harvard in 2026 where 97% of the grades given out are A's, right? It was more of a meritocracy. And something tells me that if I was in class with somebody who was 70, they would be so much more learned than me. and so much more willing to open up a book. And rarely would they be at a fraternity party at 2 a.m, right? Mistreating their bodies, that I think it would be really hard to keep my grades up with that kind of competition.
Yeah. Could be. I see it kind of a two-way street of information sharing. They might be a little challenged on the technology front where the underclassmen can help them, but certainly they have the life wisdom that the underclassmen don't have. So maybe there's an interesting middle ground there where each side learns from the other.
Yeah, I think on the academic side, I get crushed. But on the intramural side, look out, man. Now I'm the
There you
star
go.
of the intramural basketball team.
So funny. That was the first time I heard of that. I think that's
They'd probably phase out intramurals and phase in shuffleboard, right? And then I'd be back to square one.
all right. Should we close with a slice of life,
Sure.
Manus? We've got a 3-day weekend ahead, bookmarked by Juneteenth on Friday and Father's Day on Sunday. What are you looking at?
Well, I always love the 3-day weekend. It's a great way to refresh. And Juneteenth is kind of new. It wasn't a holiday recognized. And I apologize because I do know that just like other holidays like President's Day and Veterans Day, it's not universally recognized. I wish it was, so that everybody had the day off. I think it's a great thing, but it's great to have that day off in the middle of June now, to spend a day at the beach or spend a day with your grandkids and so forth. So I love that. Then we have Father's Day. I love being a father. One of the greatest gifts anybody could have. I love that. I do miss my own father dearly. I'll give a 15-second tribute to him. When he passed a couple of years ago, and I had to give a few words in his honor, I referenced some of those progressive ads, right? We want to avoid turning into our parents. And they say, don't be the guy who's correcting people who has 10 items at the checkout line that's only for 10 items, or don't help people back their car out of a parking space. I used to joke that I would aspire to be my father, that he was one of the 80% of Americans that were probably 90% of Americans that showed up for work every day, paid his taxes, raised his kids to be as best he could, to be good human beings, helped his fellow neighbor, gave some change to the poor whenever he had it, and was one of the tens of millions that are just like that never get an attaboy, never get a slap in the back, but where would we be as a country without them? And so, man, that's my way of saying thank you to all the fathers out there that live their life that way and provide the starch for what is America, in my opinion, and the mothers. I wish I had given a similar tribute to mothers around that time in May, because it's those 85, 90, 95% of Americans that make this country great, make it tick, and yet are often overlooked.
That's wonderful, Manus. I love that sentiment. He sounded like a great guy. That was a nice tribute and gives us all something to think about on Father's Day, whether our dads are still here or not. So hope everybody has a great day honoring their fathers. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great holiday weekend.
Let's go.